Rezolve AI PLC is trading right now at 472. That's up 0.28 on the day, a solid 6.31% gain. Now, the easy assumption, the one most people checking this on their Robinhood app or SoFi Invest platform are making, is that this is just another AI name getting swept up in the sector enthusiasm that lifts giants like Nvidia stock. But if you look closer at the trading data, this 6% pop isn't broad market buying. It looks much more like a technical squeeze, a low-float dynamic that has very little to do with the company's actual artificial intelligence platform and more to do with speculative positioning. The expectation is that AI is a magic word that prints green candles. The reality is that this is a small-cap stock with specific and risky fundamentals, and today's move is a perfect example of its inherent volatility. Let's be clear about the market narrative for RZLV. It's incredibly simple. It has AI in the name. Investors, especially those new to self-investing or just moving over from managed accounts like Schwab Intelligent Portfolios, are conditioned to hunt for the next big thing. They might feel they missed the boat on Apple stock 10 years ago. They felt the pain of missing Tesla stock during its massive run. And they are watching Nvidia stock breach new highs, feeling left behind. The expectation is that Rezolve AI at under $5 a share is their lottery ticket. It's the ground floor opportunity to get into the biggest trend of the decade. They see this 6% jump and the fear of missing out kicks in hard. But the reality of trading stocks this size, in this part of the market, is completely different. This isn't Fidelity offering you a stable, diversified Fidelity mutual fund or one of their core Fidelity ETFs. This is the deep end of speculation. The 6.31% move we are seeing today is happening on volume that, while picking up, is still relatively thin compared to a blue-chip company. What this signals to traders using more advanced platforms, maybe interactive brokers, is that it doesn't take a huge amount of capital to push this stock around. The reality is that RZLV is a sentiment vehicle. Its value isn't derived from its current price-to-earnings ratio, which is likely non-existent. Its value is derived from the promise of future earnings, and today, that promise is just 6% stronger in the eyes of a small group of active traders. Let's break down the recent price action. RZLV has been incredibly choppy. If you pull up a chart on your Fidelity trading platform or even the basic Robinhood stock trading interface, you'll see this isn't a smooth upward trend. It's a series of violent spikes followed by deep, painful pullbacks. Today's 6% jump is, in context, a recovery from a recent dip that threatened to break below key technical support levels. The expectation from bears was that if it broke that support, we could see a cascade of stop losses, pushing it back toward its lows. The reality? Buyers stepped in right at that critical line. But who are these buyers? It doesn't look like a massive institutional buy-in, the kind that Fidelity Investments or a large pension fund would make. This is more likely retail momentum chasing, combined with short sellers covering their positions to lock in profits, which in turn fuels the upward squeeze. We also have to place this 6.31% move in the context of the broader market. The macro environment is jittery. When the big tech names, the Apple stock and Tesla stock of the world, get volatile, some high-risk capital looks for new homes. Sometimes it flows into crypto, which you can trade on Robinhood Crypto or SoFi. Other times it flows into speculative microcaps like this. Rezolve is benefiting from the perception that AI is insulated from economic downturns, even if that assumption is deeply flawed. The reality is that if enterprise spending tightens, a B2B platform like Rezolve, which relies on companies signing new contracts, is one of the first budgets to get reevaluated or cut. So this 6% move is happening despite a questionable macro headwind, which tells me it's a very specific stock-focused move rather than a sector-wide vote of confidence. The volatility here is the main story. It's a trader stock, not necessarily a set-it-and-forget-it investment for your individual brokerage account. It makes me curious. Comment below with how many shares of RZLV you are holding, or if you're just watching this one from the sidelines. Now, for those who just saw the ticker pop up on a scanner and bought the 6% momentum, what does Rezolve AI actually do? This is where the expectation versus reality gap gets even wider. The expectation, fueled by the Nvidia stock halo, is Nvidia AI, complex data centers, large language models, foundational tech that changes the world. The reality is that RZLV is primarily a mobile engagement and e-commerce company. Their technology, often called Rezolve Brain, isn't competing with OpenAI. It's designed to bridge the gap between a physical or digital advertisement and an actual transaction. It's about closing the loop in advertising. They aim to make any media shoppable. This is a B2B model. They don't sell to you, they sell their platform to brands, media companies, and retailers who want to reduce the friction between seeing and buying. This isn't a bad business model. In fact, it's quite clever. But it's a sales-driven organization. Their success doesn't depend on having the smartest AI on the planet. It depends on their sales team signing up major partners. This is where we look at past performance. The company came to the public market via a SPAC manager, and like most SPACs, it came with a lot of very optimistic projections. The expectation was rapid, exponential adoption by major global brands. The reality has been much, much slower. They have announced partnerships, yes, but the revenue ramp-up hasn't yet matched the initial hype. This is precisely why the stock isn't at 50. It's at 472. The market is in show-me mode. It's not buying the story wholesale anymore. It's waiting for the numbers. It's waiting for an earnings report that doesn't just promise future growth, but shows actual, substantial recurring revenue. People looking for investment help often get confused by this. They see AI and think tech, but this is really a media sales company with a tech backbone. If you dig into the filings, which is something you should do whether you're investing online through SoFi Investing or managing a complex portfolio with interactive brokers, you'll find the institutional ownership is relatively low. This isn't a stock that Fidelity Wealth Management is piling its clients into for their Fidelity IRAs. A low institutional float means higher volatility. It's dominated by retail traders and a few concentrated funds that got in early. This explains the 6% move today. It's a crowd moving in, not a smart money consensus. The expectation is that all AI stocks are loved by Wall Street. The reality is that RZLV is still an on-the-radar or wait-and-see name for most big players. And the risks here are significant. The main risk is simple: irrelevance. The expectation is that their scan-to-buy technology is unique and defensible. The reality is that they are competing with the most basic function on your phone, the QR code. Apple and Google have made scanning QR codes native to the camera. Why would a brand pay Rezolve for a proprietary system when a free, universally understood QR code does 90% of the job? That's the billion-dollar question that RZL management has to answer every single day. Their argument, of course, is that their AI brain is more flexible. It can recognize images, audio, and watermarks, not just a black and white box. But is that a nice-to-have or a must-have feature? Right now, the market is betting it's a nice-to-have. The other major risk is cash burn. Companies like this spend heavily on research, development, and, most importantly, sales and marketing. If those big, transformative contracts don't land soon, they'll have to raise more capital. That typically means a secondary offering, which dilutes existing shareholders and puts significant downward pressure on this 472 price. That's the skeleton in the closet for almost every small-cap growth company. So, what's the future outlook? How do we trade this 6% pop? If you're a long-term investor, the expectation might be to buy this in your Fidelity brokerage account, ignore the noise, and hold it for 10 years, hoping it becomes the next Apple stock. The reality is that this is a high-risk venture. The binary outcome is very real. This stock could go to $20 or $30 if they sign a few major Tier 1 global partners. Or it could go to $0.50 if they burn through their cash and the competition from QR codes proves insurmountable. That's the skeleton in the closet for almost every small-cap growth company. So what's the future outlook? How do we trade this 6% pop? If you're a long-term investor, the expectation might be to buy this in your Fidelity brokerage account, ignore the noise, and hold it for 10 years, hoping